Good afternoon, ladies and gentlemen. Welcome to the Liberty Call. It is Tuesday, August 2nd, 2022. Hope everybody's having a great day out there. My beard's a little fluffy today. Took the little boy back here, Jake. You can see him resting back by the door. I took him to the vet and having to wrestle him for about 30 minutes while the doctors poked and prodded and made sure he was in tip-top health. My beard's a little bit of a mess. Could probably use a trim too. So anyways, hope everyone's having a fantastical Tuesday out there. Kind of an ugly day in the markets. Kind of across the board. There's not a lot of green on there. But again, if you've been following along and watching these on a regular basis, this is not surprising. We're due for this, and it's just the natural cycle we need to go through. But between the Federal Reserve and those in the administration and the previous administration, they like to fudge the numbers over the years to make things look better than they really are. But it's going to be a rough ride, folks. Just buckle in, and hopefully you're working with someone who is helping to navigate the ice field that the Titanic is heading into right now. So anyways, if it's your first time watching, give me a big old thumbs up. Woo! Big old thumbs up right there. Smash that subscribe button, the like button, all that good stuff. And share it with some friends and family. I'm sure there's a lot of folks out there who are just wondering what the hell's going on right now. And, I'm here for you. If there's someone, I'm never turning anyone away who seriously wants help with their finances or just, what's going on. So anyways, all right, well, let's go ahead and jump into today's numbers and see how things turned out. Dow Jones was down 1.23% or 402 points, closed at 32,396, still above 30,000, which is pretty outstanding. The S&P 500 down 0.67%, closed at 4091. The NASDAQ was barely down 0.16, closed at 12,348. Small caps were slightly up 0.18%. The VIX was up 4.77% today. It's currently sitting at 2393. Moving on to the other exchanges here in the Americas, Canada was down 0.95. Brazil up 1.11%, one of those outliers. Mexico down 1.09. Jumping across the Atlantic, Germany was down 0.23. The UK basically flat at down 0.06. France down 0.42. Euro stocks down 0.59. The Netherlands down 0.33. Sorry to my Dutch friends out there, especially with a Dutch surname like Dahlman. See here, Spain up 0.15, Italy down 0.35, Switzerland down 0.25, and Portugal down 0.29. Moving further east across the globe, in Russia, both Russian exchanges were down. The MOEX down 1.96 and the RTSI down 1.99. Moving over to Asia, Japan was down 1.42. Australia basically flat at up 0.07. New Zealand down 0.08. Moving over to the Chinese markets, the Shanghai was down 2.26. The SESE component down 2.37. The China A50 down 1.61. DJ Shanghai down 2.25. Hang Seng down 2.36. And the Taiwan weighted came in down 1.56. So most of the major players out there were in the red. Like I said, there were a couple of outliers, Brazil being one of them. But other than that, kind of a cruddy day in the market. So, like I said earlier, not a surprise if you've been watching along. The downturn that we went through at the beginning of the whole COVID thing really was the downturn we were due for, because in late 2019, the repo markets at the Fed were just a complete mess. The yield curve had inverted in the fall of 2019 going into winter. And, when things started to get rocky in, February, early March of 2020, I was like, hey, we're due. This is it. Let's buckle in. Let's adjust our portfolios. Let's reduce our risk exposure in equities, make some other adjustments. And, this might take a year or so for it to bottom out. But, hey, we'll watch everyone lose all their money and then start over at the bottom, kind of like we did in 2008 and 9. Well, I did not expect the Federal Reserve and the government at the time, which was the Trump administration. I beat up on both sides. They're both idiots, in my opinion. They came to the rescue with what? How much money did they create? I think it was like $5 or $6 trillion over a very short period of time. You had all those stimulus bills that were using that newfound money, pushing it out into the economy. Unfortunately, most of it went to big business and into the pockets of the politicians, in my opinion. But very little went down to the little people. And I think for folks like myself who are not in the super high tax, up at the very high of the pay scale, but certainly above middle and upper middle class, we didn't get anything. I mean, I think we got a little bit of a payment in that first run, and between my wife and I think we got $700 or $800, which I think was about half of what was going out to your average citizen. And then we didn't dig into anything else after that. Again, didn't need it. We both have great jobs that allow us to work from home. So it's not like we had travel. And actually, my wife, she travels with work, and she's been stuck at home with me for the last 2 years. So, anyways, I could ramble on about all that, but like I said, this is a necessary, going through these downturns in the stock and bond markets is just a natural thing, and it flushes out all of the malinvestment that's built up over really since the last downturn in 2008 and 9. So, plus interest rates have been kept at extremely low rates artificially for all of this time, and which has caused a lot of, again, malinvestment and created an asset bubble. So are stocks appropriately priced right now? I don't know. I'd probably venture a guess to say they're probably not. So, all right, let's go ahead and read through today's market recap. S&P 500 in wild swings as yields jump on hawkish Fed speak, geopolitical tensions. S&P 500 swung between gains and losses on Tuesday on rising geopolitical tensions and a surge in U.S. Treasury yields as Federal Reserve members talked down the prospect of a pause on rate hikes. Geopolitical tensions ratcheted up, probably a better term to use, up a notch in intraday after Chinese battery giant CATL reportedly said it would pause plans to invest billions of dollars in a new U.S. battery plant because of House Speaker Nancy Pelosi's trip to Taiwan. Oh, no. Now, I'm just speaking for myself here. If something unfortunate were to happen to that, drunken bad person, I would not be sad at all. And I really wouldn't even be mad at the Chinese. So she's an evil person, and I'm trying to keep this as clean as possible, so so that the social media providers don't pull down my video. The House Speaker arrived in Taiwan despite Beijing warning of retaliation over the visit. Ooh. She probably wanted to check on her chip stocks that her and her husband were buying over the last few weeks. Got to check on their investment. Big tech, meanwhile, traded mixed after Treasury yields surged following remarks from Fed members playing down the prospect of the Fed pausing or cutting rates next year. See, the people in big business really want rates down. It makes their life a lot easier to borrow money, and when you can borrow money at next to zero, makes profitability a lot better. Cleveland Fed President Loretta Mester said it would take, quote, take a while to get inflation back to that 2%, end quote, and shrugged off worries about the slowing economy, stressing that a slowdown is necessary. I think I just said that. The comments arrived just hours after San Francisco Fed President Mary Daly said the Fed's job is to bring inflation down was far from done, end quotes. Losses in consumer stocks were kept in check by a jump in Tesla and a jump in cruise stocks. Tesla cut losses to climb more than 1%, adding to its more than 30% gains seen in July ahead of the electric automaker shareholder meeting on Thursday. The meeting, which will include a vote on the company's 3-for-1 stock split proposal, will also be closely watched for any updates on Cybertruck, Tesla's all-electric pickup truck. Wow, Tesla's making a truck. Something else I won't be buying because electric doesn't work for how I use a vehicle. Healthcare stocks were helped by a rally in Intuitive Surgical, Dexcom, and Zimmer Biomet Holdings, with the latter up more than 5% after the medical device company raised its outlook on revenue following better than expected quarterly results. Energy stocks, meanwhile, were flat despite an intraday rebound in oil prices amid uncertainty about whether major oil producers will decide to lift production at a meeting on Wednesday. Commerce Bank said that while the outcome of the OPEC Plus meeting is, quote, impossible to predict, there is more to suggest that the current production volume will be left unchanged, which should help prices to stabilize, end quote. Yeah, the Saudis, I mean, everything they've been saying, at least, again, I don't sneak into their meetings. I have no idea what they're saying behind closed doors, but everything that they're putting out publicly is that they're at full capacity. And, if we would only pump more oil here domestically, we would have, a lot less problems and probably bring down prices dramatically. Plus, if we use nuclear to power all of our cities, that would take a huge strain off of the energy sector. But hey, no one listens to me. I'm just some moron sitting out here in the mountains who just enjoying that fresh, clean air. Let's see here. On the earnings front, investors digested more positive quarterly results, with Uber the standout performer. Uber Technologies reported its maiden positive cash flow and a revenue that topped expectations, offsetting a wider than expected loss to send the share price up more than 17%. Caterpillar, however, reported a miss on revenue as the impact of its exit from Russia, higher costs, and stronger dollar weighed on its performance. Its shares fell more than 4%. Pinterest jumped more than 12% despite quarterly results falling short of Wall Street estimates, as activist investor Elliott Management confirmed that it had become the company's largest shareholder, as it looks forward to helping the company realize its, quote, full potential. In other news, Cowen Group climbed nearly 8% after the financial services firm reportedly agreed to be acquired by TD Bank for $1.3 billion. Wow, that's a lot of money. All right. So, good news, bad news. It is a little odd that a company that missed its numbers so badly would be up. But, I guess when you got a big player out there scooping up all the shares, other people want to ride that bandwagon. All right, next up, U.S. job openings fell to lowest in 9 months in June as labor market cooled. The number of vacancies across the U.S. fell more sharply than expected in June to its lowest level since September, suggesting that the labor market was cooling significantly even before a raft of corporate hiring freezes or slowdowns announced over recent weeks. The nationwide number of open positions fell to 10.698 million in June from an upward revised 11.303 million in May. The Labor Department said on Tuesday its job openings and labor turnover survey for June. While it's still a high number in comparison with much of recent history, it's down clearly from a record high of 11.855 million in March and was well short of the 11 million expected by analysts ahead of time. The scale of decline is all the more surprising in light of June's employment report, which still showed job growth continuing at a historically high rate. Quote, openings are still well above pre-pandemic levels, but the slowdown is very clearly affecting the job market now, said Daniel Zahow, lead economist at Glassdoor, via Twitter. He pointed to a particularly sharp drop in retail vacancies, which fell by 29% from a month earlier. That tallied with a series of warnings from U.S. retailers at the end of the second quarter about the need to focus on keeping a lid on costs after seeing inflation eat into sales and profit margins. Zhao also noted that the ratio of open jobs to available workers also fell clearly to 1.8, while the reliability of that metric has been questioned in the past. Zhao noted that it's been highlighted several times by the Federal Reserve Chairman Jerome Powell in the context of the Fed's efforts to cool the labor market. Labor Department also noted in its report that the number of people quitting their jobs only edged down marginally to 4.2 million from 4.3 million in May. That suggests a still high level of confidence in people's ability to find better paying jobs elsewhere. The figure sets the stage for a pivotal July employment report on Friday. If hiring slows at a rate that vacancies are now slowing, then market confidence at the Federal Reserve will soon be forced to reverse this year's interest rate hikes that will likely grow significantly. Economists expect non-farm employment to have risen by only 250,000 last month, which would be the slowest rate of hiring this year. Again, you notice how they always talk about reversing the interest rates. And, I mean, I'm only 48 years old. I'm not that old. And I mean, I entered the job market, well, I guess 1990 when I was 15. But I've been, investing in, and had a 401k and things like that over the years, since I guess the late 90s. And, interest rates where they've been the last 15 years is, obscenely low. So, I mean, it's a little shocking to see people, freaking out about, mortgage rates that are, 6%, 5.5%. I mean, it's like, come on. I mean, my first house, I think, was, around 7%. My car loans were in that range back in the late 90s, early 2000s. And I mean, and those were good rates. I had, a plus 700 credit score, and I worked in the credit and collection industry. So, I mean, that was something that was very top of mind. So keeping my credit looking good has always been, a big thing with me. So again, it's a little shocking that people are put out by having to pay a little extra in interest when, I think of my parents who, when they bought the house that my dad's still in back in 1978, I think they were paying 12%. And, again, they had excellent credit too. So it's a little surprising. All right. Well, let's take a look and see why oil is so expensive. And this comes, from the minds of oil execs. An inside look at what oil execs really think. Oil execs are walking on eggshells. They're being attacked for, quote, price gouging at the pump, sitting on record profits, destroying the planet. The list goes on. All this backlash means oil execs have to be extremely careful about what they say and do in public. They can't be direct and blunt if it would give their detractors more ammunition. Fortunately, we have an excellent, unfiltered source of information that reveals what these execs really think. That's important because not only are their thoughts very telling, I believe it's further proof that we're still in the early innings of a multi-year rally in energy stocks. Let me explain why and share my my top way to cash in. And this comes from John Malden's website and is written by Thompson Clark. Here's what top energy execs are saying. Remember, you won't get full energy by full energy story by turning on CNBC, but you will by turning to the Dallas Fed. See, every quarter, the Dallas Fed conducts a survey of top energy executives at about 200 oil and gas firms. Their survey is anonymous, which means these execs can say truly how they feel, giving us a clear picture. Here were some of the top quotes in the second quarter 2022 survey. Quote, the government's anti-oil, anti-gas, and anti-pipeline stance has caused us not to pursue expansive projects. Quote, the country's energy policy is on the wrong path. Picking wind and solar and going faster in this direction is a mistake. The country should embrace domestic oil and gas. Next one, quote, politics are affecting our business with both sides pushing ridiculous agendas with no management or understanding at all, end quote. These executives are calling it like they see it, and their views aren't hard to grasp as common sense. Unfortunately, common sense just isn't that common these days. There are two main reasons. First, the government's stupidity. The consensus is that we don't need fossil fuels anymore, but that couldn't be further from the truth. Today, 83% of the world's energy supply still comes from oil, gas, and coal. That number has barely budged over a decade. And in this chart from 2009, you can see about 35% is oil, 30% is coal, and 22% is natural gas, making up, leaving 13% back then to be made up of nuclear, hydropower, and other renewables. Today, oil has dropped down to 31%, coal is now 27%, and natural gas is 25%. So it's actually increased where the other two have dropped a couple of percentage points. And as far as the alternatives, we got 4% nuclear, 7% hydro, and 6% other. So then that's a total of 17%? Yeah, because this totals up to 83. This quote green future everyone talks about is still a long way away. Just look at the U.S. electric vehicle market. There are 1.5 million registered EVs compared to 289 million registered cars, meaning EVs make up less than 1% of vehicles on the road. Even if EVs grew to about 5% of the market, it wouldn't dampen oil demand by much. In fact, the International Energy Agency doesn't expect global oil demand to peak until 2030. Weeks after his inauguration, Biden took action against the energy industry, pushing a ban on new drilling leases for oil and gas on public lands and offshore waters. As I wrote at the time, less drilling means less oil, and less oil with the same level of demand can only push the prices in one direction, up. It's Economics 101. Remember what that top energy exec said? The government's anti-oil, anti-gas, and anti-pipeline stances caused us not to pursue expansive projects. Since my essay in October, the price of oil has climbed 25%. You can see there, it actually peaked earlier this year a couple times. Next, I'm looking at what the energy management teams are doing. During the last energy bear market, energy firms plowed money into exploration and production. Investors, management teams, and banks all got burned. Many companies borrowed billions they couldn't pay back and ultimately went bankrupt. But now management teams have completely changed their spending habits. They're returning cash to shareholders through dividends and share buybacks. Oil majors like BP, ExxonMobil, and Chevron plan to spend $38 to $41 billion on buybacks this year, according to the Financial Times. In October, I recommended Chevron, ExxonMobil, and Chesapeake Energy and BP as smart ways to play this trend. BP has been flat, while the other three have risen 40 to 50% each. Congrats on a nice call if you took advantage. I believe this run is just getting started, and one of my favorite energies today is Ovintiv, OVV, which I recommended in my Smart Money Monday readers in June. I own shares and continue to like what I see, and the company is profitable. And yeah, okay. So, as far as whether or not you want to take this guy's advice on particular securities, that is your business. I'm not giving tax or legal advice or investment advice on anything here, but just really wanted to give you some insight into what the energy execs are saying, because these guys are in the business to make money, certainly not in the business to lose money. So, all right, last one up, article about the Inflation Reduction Act. And I heard someone say, it should be that these lawmakers should be banned from titling these things, which are the complete opposite of what they actually hope to accomplish. Kind of like the Affordable Care Act. Yeah, that did a lot to make healthcare affordable. All right, and this is written by Dr. Ron Paul, one of the greatest Americans who's ever lived. So let's see what he has to say. And is there a way to increase the font? I guess not. The Affordable Care Act, No Child Left Behind, and the U.S. Patriot Act received new competition for the title of most inappropriately named bill when Senate Democrats unveiled the Inflation Reduction Act. This bill not only increases inflation, it will also increase government spending and taxes. Awesome. Thanks, government. Inflation is the act of money creation by the Federal Reserve. High prices are one adverse effect of inflation, along with bubbles and the bursting of bubbles. One reason the Federal Reserve increases the money supply is to keep interest rates low, thus enabling the federal government to run large deficits without incurring unmanageable interest payments. The so-called Inflation Reduction Act increases government spending. For example, the bill authorizes spending of hundreds of billions of dollars on energy and fighting climate change. I'm not sure what that has to do with inflation reduction. Most of this is subsidies for renewable energy. In other words, green corporate welfare. Government programs subsidizing certain industries take resources out of the hands of investors and entrepreneurs who allocate resources in accordance with wants and needs of consumers, and gives the resources to the government where resources are allocated according to the agendas of politicians and bureaucrats. When government takes resources out of the market, it also disrupts the price system through which entrepreneurs, investors, workers, and consumers discover the true value of goods and services. Thus, in quotes, green energy programs will lead to increased cronyism and waste. Remember Solyndra? Yeah, so do I. The bill also extends the, quote, temporary increase in Obamacare subsidies passed as part of the COVID relief. This will further increase healthcare prices. Increasing prices is a strange way to eliminate price inflation. The only way to decrease healthcare costs without diminishing healthcare quality is by putting patients back in charge of the healthcare dollar. This bill's authors claim that the legislation fights inflation by reducing the deficit via tax increases on the rich and a new 15% minimum corporate tax. Tax increases won't reduce the deficit if, as is going to be the case, Congress continues increasing spending. Increasing taxes on, quote, the rich and corporations also reduces investment, slowing the economy and thus increasing demand for government programs. This leads to increasing government spending and debt. While there is never a good time to raise taxes, the absolute worst time for tax increases is when, and is the case today, the economy is both suffering from price inflation and, despite the gaslighting from the Biden administration and its apologists, is in a recession. This bill also spends $80 billion on the IRS. Supposedly, this will help collect more revenue from rich tax cheats. Yeah, because people keeping their money is cheating. While supporters of increasing the IRS's ability to harass taxpayers claim their target is the rich. These new powers will actually be used against middle-class taxpayers and small businesses that cannot afford legions of tax accountants and attorneys and thus are likely to simply pay the agency whatever it demands. Increasing spending and taxes will increase the pressure on the Federal Reserve to keep interest rates low, thus increasing inflation. If Congress was serious about ending inflation, it would cut spending, starting with overseas militarism and corporate welfare. A Congress that took inflation seriously would also take a step towards restoring a free market monetary system by passing Audit the Fed and legalizing competition in currency. Amen, Mr. Paul, or Dr. Paul. You are a genius once again. And, well, I mean, all we can really hope for is that the federal government does collapse sometime soon and will free us from the slavery that we've been in for the last 250 years. But, I don't have a lot of hopes it's going to happen real soon, but I'm cheering it on, and anything I can do to help destroy the federal government, I will participate in. I am a patriot in that way. So, all right. Well, that's everything that I had today. I hope everyone has a fantastical evening, and I'll be back tomorrow with Wednesday's Liberty Call. If anyone needs anything from me, please go to dsafinancialgroup.com. There's my email address right here on the screen. And if you want to book a meeting, drop me a phone call, shoot me an email, send me a subject matter that you'd like me to discuss on a future episode, feel free. Otherwise, I will see you guys tomorrow. Have a good evening, guys. Bye.